Our guest today is Ruth Judson. Ruth is a monetary economist, economic historian, tracker of global capital flows, and a longtime veteran of the Federal Reserve Board of Governors. She joins us today to talk about all things dollars, from physical cash to digital dollars. Ruth, welcome to the program.
Thank you.
Well, it's great to have you on, and I came across your research some time ago when I was looking up the demand for currency. And lo and behold, your name just popped up, and you have a lot of work on this, and we'll talk about that today. But you've done so much more. You've written a lot on global capital flows, the tick data. You've written on safe assets, written on money. I just learned that you were the one who kept track of the data on monetary aggregates at the Federal Reserve, the H41, and the balance sheet, and all the other good stuff. So you've seen it all at the Fed, haven't you?
I wouldn't say I've seen it all, but I've seen a lot.
Yeah.
And honestly, when you start working on cash, it's connected to so many things. It's just everywhere.
Yeah.
It was never my full-time job. It was largely like my work hobby. And every time I changed jobs in some way or another, I would think, this whole cash thing, it's over. And then lo and behold, there it would be. So, yeah, it just followed me like a puppy through my whole career.
Well, tell us more about what you did at the Fed, all your different roles you had there.
So I started at the Fed in 1994, and I was in monetary affairs, and I was in a group that, as you mentioned, tracked the monetary aggregates and maintained the models of money demand, and some, tracked the data and models for deposit rates also. I was introduced to cash at that point.
Okay.
Because, true story, they needed somebody, they had just started this project and they needed somebody they needed an economist to go to Belarus in December. And I was not yet at the Fed. And one of my colleagues and MIT classmates said, well, how about that woman who's coming soon? She said she likes to travel and she speaks Russian. She can go to Minsk in December. And there you have it.
Okay. So that Russian undergraduate education paid off, huh?
I guess so. So I was in that group for a while, and then I shifted over to the group that, or they kind of shifted the monetary aggregates work and the people from one group to another. So I moved with the work, and that group also did the open market operations. And daily open market operations is very much a matter of taste. Some people can't stand it, don't want to have anything to do with it, and some people find it addictive. And I found it vaguely addictive because, you had to come up with an opinion every day about what you thought the size of the operation should be.
Okay.
And then the New York Fed was doing the same exercise. And then you would have to come to consensus, which usually meant they did mostly what they wanted to do. So that meant that every day you also had an opinion about what the outcome in the Fed funds market would be, and the next day you would come in and find out. So, to me that was kind of addictive.
Yeah,
and I really liked it, and it was really interesting. And, I would say I started working on I started developing my firm belief in automation for all things in that setting, because it was daily and there was like a lot of information coming in, and you just had to have some systematic way of getting a handle on it every day.
Yeah.
I was in monetary affairs until 2011. Of course, we stopped doing fine-tuning daily open market operations in 2008-ish. In 2011, I moved to international finance, and I was very, very lucky in that just at the time when I was moving over there, which was, of course, to be a one-year visit, they were introducing a new data collection form. They were like, yeah, we need somebody to deal with this form. Can you do that? And I was like, it's data. It's monthly. That's so easy. It's not even daily. It's monthly. What,
How hard could it be? Right?
So that was quite fun, and the people I worked with there, including my co-author for many papers, Carol Berteau, were extremely generous in their in sharing their knowledge with me, because believe me, I knew nothing about the tick data when I arrived. Nothing.
Okay.
But Carol in particular was very generous with her time, and so we got a handle on this new data flow, and it was pretty cool. And they invited me to stay after I had only been there a short time, and I did. So after a few years, I took over running the rest of the TIC apparatus as well, and I did that until about 2 years ago, and then I decided it was time to hand it off, and I wanted to have a little more space to do other things, and I could see that I was going to retire soon, so I thought it was not optimal for me to be running the TIC thing and just walk out the door while still running it. I was just like, that is not organizationally optimal. So it was really great because I handed it off and I did a rotation with the cash group, and that was really fun. And then I had a little more time to work on digital payments and stablecoins, CBDC, whatever the flavor of the week is.
Again, you've done it all. It seems like you've worked with TIC data. And for our listeners, TIC is Treasury
International Capital.
Okay, so it keeps track of transactions.
So it's cross-border banking and securities positions and transactions.
Yeah.
So what I like to tell people is that the factoid most people have heard that comes directly out of the TIC data is how many foreigners are holding treasuries and who they are.
Yeah.
But the TIC system collects data not only on treasuries, but also on agencies, corporate bonds, and U.S. equities, and then also collects the flip side of that, which is what U.S. residents hold of foreign stocks and bonds. And then there's a whole other section of the TIC data collection system that collects banking data. And then there's the derivatives data collection. The banking data, we have other sources for the banking data as well, whereas for securities, TIC is all there is. So, so we tend to focus more heavily on the securities and especially heavily on the treasuries because, the treasury owns the data and that's what they care about. So
you've worked with a lot of interesting data, TIC data. You also have tracked closely currency held abroad. Now, does the TIC data go into the formation of the U.S. financial accounts, just manage the flow of funds? Okay. Because I want to come back to that in a minute when we talk about currency, how reliable that is. But with the TIC data, you often hear, stories about who holds treasuries. Maybe some countries are selling their data. But I also hear that sometimes the TIC data doesn't tell you everything. Like they might be holding it somewhere offshore or some other location. What can you tell us about that?
Right. So in the way the TIC data collection system works, we only have the Treasury, or we as with the authority delegated to us from the Treasury, can only collect from U.S. entities. Okay. So we will collect data from U.S. custodians, and they will say, yes, we're holding securities in custody for, entity X in Belgium or whatever. Yeah. But they can't go any further than that. So the classic example we use here is that Euroclear is a huge securities depository in Belgium, and they hold all types of securities, but in particular treasuries on behalf of many customers from many countries. But all we see in the TIC data is Belgium.
Okay.
Right. So, and in particular, all we see is that it's Belgium and that it's private as opposed to official holding, even though we strongly suspect that there are many foreign official investors who are custodying their securities in Belgium. But we don't know. We've never been able to see beyond that step.
Yeah. Well, let's go on to currency. We may come back to TIC a little bit later. And talk about money, because you started in the monetary affairs division. You worked on monetary aggregates. There's a time where money mattered. I mean, I think it still does, at least theoretically, but in practice, it's not used to guide monetary policy. There are still some monetarists out there. I have a good friend, Peter Ireland, Josh Henriksen, former podcast guest, and they use things like monetary divisia. And I have my own theory for why money isn't useful anymore, and I'll just quickly run it by you. But I think it's an identification issue. When the Fed's doing its job, and of course it uses interest rates, when it's doing its job, it's effectively stabilizing prices. It's the equivalent thing could be said. It's offsetting money demand shocks from a money perspective. And if it's offsetting money demand shocks, you're not going to see a pattern between money and the price level. If the Fed's doing its job, you're going to lose all correlation between some instrument and what you're trying to control. So I think there's a relationship there, and we can talk about maybe other things are more fundamental than the money itself. Something else is driving money. But monetary policy, modern age, we don't use monetary aggregates anymore.
I think the year I arrived at the Fed was the year that the Fed started announcing the interest rate target.
Okay.
Like saying out loud, here's our target. So my entire time at the Fed, we've been very interest rate focused. And, we maintained the money models. I don't know that we even maintain them anymore. They may be running in background, but certainly nobody is developing new money demand models at the Fed that I know of. And I think I would know. The publication of the monetary aggregates themselves dialed back from weekly to monthly a few years back.
Yeah.
Just significant de-emphasis of the monetary aggregates across the board.
I remember we used to have M3, then it went down to M2.
Yeah.
So costly.
No, I remember when M3 was discontinued.
Oh, yeah?
And my input was, okay, you'd better be really sure that you don't want it or that you're never going to want it, or you'd better think ahead. Suppose 10 years down the pike you want it. Are you going to be able to reconstitute it? And I was assured that it would be possible.
Okay.
Now, in the event, we haven't wanted it, but...
Yeah, well, again, I think it's useful and I would suggest it's useful when you're outside of stable times. When the pandemic, we saw monetary aggregates grow rapidly. Just another cross-check, even if you're not targeting it. You mentioned M3. I think it's the CFC, Center for Financial Stability in New York. They keep track of these Divisia measures, and they go like M4, these broad measures, institutional money. And it's interesting if you look at those during like the Great Financial Crisis, they actually see big contractions in them because the institutional money was crashing, right?
Well,
if you define money broadly enough, but it's only in those interesting moments, maybe interesting is too nice of a word there, but challenging moments that you see these monetary aggregates telling you something. When it's stable, it's kind of like, how useful is it? But let's move on from monetary aggregates to kind of your bread and butter, currency, right? Your specialty.
I call it my work hobby because it was never ever was it my full-time job.
Oh, really?
Yes.
But you were like the in-house expert on it.
I kind of was.
Yeah.
Kind of. I mean, we have an entire operations group that is in charge of the care and feeding of like the banknote order and currency education. And I mean, those people are great. That's the group I got to visit when I was, after I got done with doing TIC all the time. And they're absolutely great. But they sit in our Reserve Bank operations area. And then, on the domestic side, on the economic division side, it's the monetary affairs group. The same people who do the rest of the monetary aggregates, who in principle are in charge of tracking currency.
Okay.
For me, it's just like, it is just a hobby.
Yeah.
But the problem is, I'm a data squirrel. And so I'm on all these mailing lists for monthly data dumps. And I've made sure I stay on those lists. And so whenever, like when COVID hit, I was the only one who knew where all the bodies were buried and where all the, and I remember sending an email over to Monetary Affairs saying, okay, I can do this. I need this, 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 and this. I have this, this, and this, but not this. You guys have this. This person has that. So, yeah.
Yeah, because currency did spike during COVID.
Oh, my gosh, yeah.
And let's come back to that. Before we do that, though, maybe walk us through the very basics. Like, how is currency issued in the U.S.? Who controls it? Kind of like maybe the institutional apparatus supporting currency in the U.S.
So we supply currency on demand. If a bank wants currency for its so you can get currency from a reserve bank if you are a member bank, right? If you have an account at the Fed. So that would be banks. So banks will decide that they need to stock their ATMs or stock their teller windows or whatever.
Yeah.
And they will put an order in to their local reserve bank. The currency is supplied on demand and free of charge. Their account is debited, and the bank will have to, send the armored carrier there and pick it up and make all those arrangements. And I think at various points in time there have been some incentives provided to not have banks like bring in a bunch of dirty currency and then the next day withdraw the same denomination clean, right?
Yeah.
So, but in the main, it's free, it's supplied, or it's at cost, it's on demand, and so all the production decisions are made based on what expected demand is. There are other decisions about. It's quite complicated, actually, because they have to decide how much to order. They have to decide when the banknotes come back in. They have to decide how worn is too worn before a note gets shredded. And in some cases, they've had to adjust those standards to increase supply in the short run. Mm-hmm. But basically, currency is supplied on demand.
Yes, demand-driven, and you have this wonderful chart in a recent Fed note. Maybe we can talk about this more too in a minute. You showed the Fed's balance sheet going back 100 years. It's really cool. We'll provide a link to it, listeners and watchers of the video. But in it, one of the kind of steady parts is this currency part. Yeah. In fact, people sometimes call it the currency franchise because it's a cheap funding source for the Fed, an important cheap funding source for the Fed. But it's demand driven. It's one of the parts of the Fed's balance sheet that the Fed kind of doesn't have control over.
Yes, it's called an autonomous factor.
Autonomous factor, like a TGA, Treasury General.
Yes, TGA is the other autonomous factor.
And that one, we've had a lot of conversations on this podcast. I'm sure you have as well. How the Treasury General account, which is the federal government's checking account at the Fed, it can have some big swings, particularly the big deficits we're running these days. And that's the unpredictable one. But currency demand is fairly steady, though, right, over time.
It has been. It used to be back in the day of scarce reserves, the TGA was quite small because any funds beyond a quite narrow range were basically farmed out to banks.
Yeah.
But we don't have that system anymore. And I don't know if there's any chance that it will ever come back. But yeah, the idea of the practice of having the entire TGA be at the Fed started basically in 2008, 2009.
Yeah.
So yeah, of course it's quite volatile, but it used to be constrained to a range between $5 and $7 billion a day.
And now it can be far larger.
Oh gosh, yeah.
And I just had another podcast with Bill Nelson, and one of the things we talked about are some of these proposals to effectively neutralize or almost even partition the TGA in a way. Annette Vissig Jorgensen has this proposal of building a bunch of treasury bills up. You kind of offset, do open market operations to offset swings in the TGA. And Bill has a similar one with repo, use repo to money comes in, put it back out and vice versa so that it becomes less of an issue because it's one of the reasons, argued for an ample reserve system. You got to have plenty of reserves because if there's big swings and reserves are affected, then you lose monetary control and so on.
I mean, there's ample, but you don't necessarily want crazy ample and volatile.
Yeah.
But yeah, Annette is still is in monetary affairs, and I haven't spoken with her, and so I don't know why it doesn't seem to be an option to go back to it was called the TTNL, the Treasury Tax and Lending System. Anyway, it was TTNL was the way that the TGA was allocated across depository institutions.
Well, there is a new Fed chair coming in, and he's looking to shake things up. So maybe. But
I don't know. I just haven't had that conversation with anybody about maybe it's wildly impractical for some reason. I
think I recall one of the reasons the TGA became so important was because it was cheaper to have the federal government park its funds there than it was at the banks when they started paying interest on the reserves.
Oh yeah.
So there's a tax incentive, tax reasons we as taxpayers should care about. But back to currency, I want to go there because again, you are kind of the in-house expert, or you were the in-house expert because you're now officially outside the Federal Reserve.
I'm on the outside now.
On the outside, but you're still an expert. What drives it? And in particular, this recent period we went through with COVID, it spiked, right?
Oh, yeah.
So
Oh my
what
gosh,
is
yes.
your understanding of what happened and what's driving that currency demand?
So the interesting thing about the COVID episode was that in the very short run, so like say the first 3 months, about a third of the demand was foreign,
Okay.
about a third was domestic, and about a third was just banks loading up their vaults to the ceiling.
Hmm.
And to me, that was entirely understandable, right? I mean, we really had no idea, and certainly if you were trying to fill ATMs, you had no idea whether, if you were a bank, you didn't want your ATMs to run dry. You didn't necessarily know when you would be able to get another shipment of cash. So yeah, there was a huge run up in vault cash. So that was a piece of it. The foreign was a piece of it, and then the domestic was a piece of it. It's straight up precautionary.
Okay.
I mean, we know that people weren't going to stores, so more payments were being done electronically. But it was straight up precautionary. I mean, you heard stories about people nonetheless running out to the ATM and
Yeah, it's a little bit puzzling though. I mean, as you mentioned, like probably both of us do most of our transactions online, maybe even with apps. And yet this precautionary demand for cash, and it's still pretty large, right? It's not like it's come down a lot, or has it?
So the thing that was really surprising was that currency demand remained super strong through 2020 and also 2021.
Hmm.
And then we had a little bit of a take back in 2022, 2023. And I think, I think it's still not clear what the longer term trend is going to be, whether we're going to see a lower trend going forward or whether we'll go back to sort of the usual trend. On the domestic side, and with it, so I think in the paper I have about currency demand, I break it down by denomination. And so we're seeing really slow growth in the smaller denominations, and in some cases negative growth. And that tells me that for domestic transactions,
Yeah.
currency is less commonly used now. But we still see very strong growth in the larger denominations. So, maybe that's international demand. We definitely see spikes in international in currency growth and in international shipments whenever there's a crisis in one country or another. And maybe some people will tell you that it's underground economy, but first of all, that's really hard to assess.
Yeah.
And second of all, it doesn't show any particular patterns, right?
Yeah. Well, it's interesting. This going back to this point you made earlier that even though we live in a largely digital age, and I was recently on a podcast discussing this with Dan Ari, because he has a book out on, there's old money, new money, and good money, bad money. And it was in the context of stable coins. Like the next generation definitely is all digital payments. Venmo, Cash App, PayPal. And the notion of taking out physical currency, just nobody carries physical cash, a younger generation than our age. I should be careful. I'm sure there's some who still do, maybe who operate on the margins of the economy and, maybe those being afraid to be captured by certain federal agents. They're still carrying a lot of cash around. But a majority of people are using digital transactions of the younger generation, yet there's all this domestic demand for physical cash.
Yep.
And is it just older people using it, or maybe beyond the maybe illicit or people who are concerned about their their standing in society? Beyond that group, is it just older people using it? What's your sense?
I wish we knew more.
Okay.
We do have some very nice surveys on payments, but even those surveys can't really account for as much currency as we have in circulation. So it's kind of a mystery. And I mean, I have a little bit of a side hobby because an empirical regularity is that if I'm talking to somebody about, oh, you work at the Fed, what do you do? I almost always tell them I work on cash because nobody wants to hear about the other stuff, let's face it. Nearly every time I start talking about cash, they will tell me a story about their mother, their brother, or their whoever who's got a shoebox full of cash.
Okay.
It is, I mean, it's an empirical regularity at this point. So there's a tail out there of people who are holding a lot of cash, and those people are not going to be participating in these surveys.
I see. Yeah.
And every so often I'll hear something about somebody paying for something with cash, and I'll be like, can you tell me more about that? Mm-hmm. But I mean, there has to be a certain level of trust, because otherwise they're like, why are you asking me this question?
You're fed. So do you see a role for cash? So put aside like what the data shows. I mean, you've looked at this for a long time. And let me just give like two stories here. The reason I bring this up. So I'll give my brother and his family. They were in Asheville, North Carolina when the hurricane came through, and it was a lot of destruction. Their home wasn't harmed, but they were, surrounded by water. They had to get out. And they got out, but everything was shut down in terms of power. And so they had hardly any gas in their vehicle. They get to the gas station, and they only took cash. And my brother did not have cash. My sister-in-law, my niece did. So they took my niece's physical cash. There's a data point of a young person holding cash. But in any event, they were able to buy gas until they were able to drive out, get to a place that was still operating with electricity. So I can see moments like that. Let me give it. And the second story I want to give is from a previous guest of the podcast. He works at the Riksbank, Per Osberg Sommer, and he was telling me, that in Sweden they really pushed hard to get rid of cash, as you probably know well, starting like 2015, early 2010s, and they did. They got rid of a lot of cash. Look at currency as a percent of GDP. It's
they're the poster children.
Yeah, but now they're having regrets. They're like, well, maybe we want some physical cash for people who aren't a part of the digital payment system or for emergencies.
Yes.
So I guess just stepping back as an economist, looking at trade-offs, we don't want to have a purely cashless society, do we?
So I think people would be very uncomfortable with that. I think that in the case of Sweden, they actually have offline capability for their payment system.
Okay.
But they are very concerned about the inclusion effects of, older people or people in remote locations, and, the bank doesn't have cash anymore.
Yeah.
And I think that's a problem we want to avoid. And I think there is a fundamental privacy consideration too. That
yes.
To the extent that you're concerned about privacy, it's useful to be able to pay with cash if you have a concern. And especially when we talk about the potential for a CBDC, which, by the way, in the U.S. is absolutely not on the table at this point. But you could imagine that if there were a CBDC, that people might think, it's one thing if like Visa or Target knows about all my spending, but the government, it makes me uncomfortable.
Right. So we might see even more demand for currency pickup in setting like that.
Yeah. Well, and the Chinese, when they introduced their central bank digital currency, they were quite upfront about the fact that they wanted to compete with the private providers, and also they liked the idea that they could get the information.
Yeah, a little scary. And there's a great case study of how it can be used, and it's probably the most successful CBDC to date. Would you say is China, or
it's the most successful? And even so, I mean, there are 4 or 5 CBDCs that have been introduced, and they've just had absolutely minimal take-up.
Yeah. So. And we can talk about the CBDC. I recently had some guests on talking about the case in Europe. Like the Europeans, they're doing a very watered-down version of CBDC because they don't want to harm the banks. So banks are very important. They've kind of put the throttle on private stablecoins, like euro-based stablecoins. And they're kind of, throttle might be too strong of a word, but, they put in caps and limits on how much someone can use a CBDC. And that's to protect the banks. But the comments I got were, well, that also opens the door for dollar-based stablecoins to step in and fill the void that they have created by a policy choice.
Well, they've been quite explicit that they consider dollar stablecoins sort of a risk to their monetary sovereignty. And so it's an interesting regulatory and diplomatic challenge.
Yeah, so
right?
that is so interesting to me. It's like they see this, they know what they're doing. I mean, just help me understand them. Why don't they do something different? Are banks too powerful? Are they too stuck in this path dependency? Or
I mean, if your residents want dollars, there's not much you can do about it. You can make it harder.
Mm-hmm.
But generally, and this goes for stable places like Europe and also for unstable places, the best thing you can do is make your own currency more appealing and stronger.
Yeah.
Right? You're not going to scare people out of holding a safe asset, and if they view dollars as a safe asset, they're going to want it.
Yeah. Well, it is interesting to see all this conversation there, and I guess I've just been a little puzzled by they're putting themselves in this place by policy choices they are making. Then B, how much of a threat is the dollar really over? I mean, are people really going to start using the dollar that much? I mean, as an American, I'm actually excited about it's extra seniorage. Of course, dollar-based stablecoin seniorage to private firms, but nonetheless, it's demand for treasuries, though, at least indirectly. I mean, it's from our perspective. In fact, some of the ECB officials I've read, they talk about it not just about losing monetary sovereignty, but about continuing to finance American deficits on the back of our money, giving up our money sovereignty. So they are worried. And I guess,
they're
does it not
worried.
seem a little bit overly worried to you? Or is there a legitimate fear that we could start seeing dollars being used in Europe as much as euros?
I think it's not unreasonable that they're concerned.
Okay.
I think the scenario where dollars completely displace euros, I think, is kind of a fringe case. But, part of what you do as a central banker is you worry about fringe cases. Like, that's your job.
Okay. Good point.
That's
a good point.
I've had to tell people, I've made this type of statement many times. Yeah, it's kind of our job to, at least think about the fringe cases. And we can acknowledge that they're low probability, but we still need to think about them.
Yeah. So a few more questions on currency. I want to go back to tick data and some of the research you've done with that and safe assets. But you go to places overseas where there is hyperinflation or very unstable monetary regimes. Venezuela, maybe today, Zimbabwe back, 2008. And I have actual physical currency from Zimbabwe. I have
so do I.
I got that run from, and it's a great illustration. I used it when I used to teach. I've used it in talks where you show the bills, and they were dollars, and it was in English, $1, $5, $10, $20 bills in Zimbabwe early 2007. Of course, by the end of, I think it's November 2008, there's a $100 trillion bill.
Uh-huh.
And they finally, okay, that's enough. But what was interesting in that story is people in Zimbabwe were trying to use dollars and South African rand to a lesser extent, and the state was like, no, we're going to arrest you if you use this foreign exchange. And finally, the state said, okay, we give up. And so dollars just magically appeared out of nowhere. And so I wonder, what if they'd had dollar-based stablecoins back then? They could have evaded the state even easier. They would have been avoid the threat of arrest carrying physical currency around.
Yeah, I mean, we have to rewind and remember what the technology was then. I mean, I don't think people had smartphones then, for example.
Right.
But I remember having a conversation with somebody at the IMF about, they had this very elaborate model of, for forecasting inflation in Zimbabwe. And I said, all you need to do is go and look at the black market versus the official rate for dollars, and there's your answer. You don't need anything else.
Yes, yeah.
But yeah, I was soon after I joined the Fed, I was on a really fantastic project where that started with that trip to Belarus that I mentioned, where it was a sort of cross-agency team, and we traveled to countries that had either known high dollar usage or reported high counterfeiting incidents. And so we had people from the Secret Service because they cover counterfeiting.
Cool.
We had people from the Treasury because they cover banknote design. We had people from the New York Fed because they cover, they operate the biggest vault with the biggest distribution. So for me, I mean, it was absolutely fantastic because I got to meet and work with everybody.
Yeah.
And, best field trips ever. Went to all these amazing vaults and stuff like that. And that was, and at that time also, you couldn't just look up on the internet what was going on. You kind of had to go.
Yeah.
So that project went on, that became a congressionally mandated project, and it went on for about 10 years and ended in 2007. And unfortunately was not renewed.
And the goal of that was to just count and track the amount of dollars overseas. Okay.
Yeah, and so part of the enabling legislation was that we had to write a report. So there are actually 3 reports from the Treasury called "The Use and Counterfeiting of United States Currency Abroad." Part 1, Part 2, Part 3.
Okay.
From 2000, 2003, and 2006.
This is where we get that 2/3 of our currency is overseas data. Okay.
Yeah.
Interesting.
I mean, I've updated it since then.
Is that still a good approximation or not?
I mean, what I like to say is as much as 2/3 or between half and 2/3
of the currency is overseas.
Yeah. Because we really don't know. It's exceptionally hard to measure.
You brought this up, so I want to spend just a few minutes there before we go to safe assets. I promise we'll get there. But counterfeits. So you have an article out, and I'll encourage listeners to go to your website at the Fed. I assume it'll still be up for some time.
I guess.
But a number of your interesting articles there. One was on counterfeits, and I think you said up to $30 million in counterfeit notes, or is that about right?
That sounds about right. So we had part of the legislation required that we produce estimates of counterfeits, and so I did. And those estimates were in the reports, and the Secret Service cited them for years. And when I was on my rotation in cash, I said, you've been citing these numbers that are from 2005. Maybe we should update them.
Yeah. Because
they will be lower, I promise you. And sure enough, they were lower by like a factor of 10. So
why were they lower?
Well, we have better banknotes now.
Okay, technologies.
Yeah, technology is
harder
amazing.
to counterfeit than.
Yeah. But you have a couple different data sources. You kind of have to square the circle and whatever. So, I mean, so I was very happy to get that out.
Okay, so it is harder and harder to counterfeit.
Yeah.
Now, I know some notorious cases in the past, like North Korea was a famous. Yeah. Do they still attempt to counterfeit? I mean,
I don't know.
I guess the question is
that's in the category of Ruth doesn't need to know, so we don't.
Yeah.
Tell
Okay.
her.
Maybe a state secret there, but I guess the 30 million number seemed, I mean, to me, honestly, a little bit low. Like if I were North Korea, $30 million is not going to get you much, right? But maybe it's enough to keep the ruler happy. I don't know, North Korea. But if you got a whole country dedicated to counterfeiting, I think there'd be a lot more than that. But it's remarkable, which is a testament to whoever makes the bills. And in fact, is it a U.S. Mint that engraving?
So the Bureau of Engraving and Printing, which is right downtown.
Okay.
I think it's the second most popular tourist destination.
Not far from
in
here
DC.
in the studio, yes.
So the Bureau of Engraving and Printing has one operation here in D.C. and then another one in Fort Worth.
They're the ones that have all the.
They actually make
the notes.
They print the money. And we have quite active efforts underway to assess what future banknotes should be like and what security features are effective and are durable, because we have very stringent standards for banknote durability.
Have you watched any of the movies where the people either A, try to rob a regional Federal Reserve bank because of the currency distribution, or B, major counterfeit operation? You ever watch these movies and no, that doesn't work. That does work. Yeah.
Yeah.
Okay. Yeah. Your kids are like, or your family's like, please just be quiet. Let us enjoy the movie.
Yeah.
Okay.
Yeah. But yeah, Mad Money is a particular guilty pleasure.
Okay.
Come on, it's got Queen Latifah, Katie Holmes, and Diane Keaton.
All in one setting. Yeah, that's awesome. Yeah, there's been some fun movies out there about like robbing.
But then there's the Die Hard movies.
There's the Die Hard movies. There, I think it was Reacher on Amazon Prime. They had I think the first season, what they had was a counterfeiting. It's near the end of the season. The big reveal is the criminal operation is they're taking like $1 bills, bleaching them and using the print like some higher denomination because the material itself is important. I'm like, would that really work?
So that's why, those pens that they use at the store,
yeah.
From what I understand, they detect one of two things. One is they detect wood pulp because real banknotes are made from rag and don't have any wood pulp. And the other is that they detect bleach because real banknotes are not bleached.
Okay, so someone who tried that would be caught. So, all right. Well,
but generally with counterfeits, the thing is, it's one of these fool me once, shame on you; fool me twice, shame on me.
Yeah.
So once you can usually get away with passing a not very good counterfeit once, but not more than that.
Yeah. Okay. Now, in the Federal Reserve System, like I believe that the New York Fed is the biggest distributor of notes.
Yeah,
is that right?
I think so.
And then somewhere 2 or 3 down the list is the Atlanta Fed, I believe.
So Atlanta is really big because the Miami cash office is part of the Atlanta Fed.
Yeah.
So there are reserve banks, and then there are offices, which are like satellites of the reserve banks. And the offices can and do open and close over time depending on operational needs.
Mm-hmm.
So like we used to have a lot more offices when we had paper check processing, and then a lot of them closed. But Atlanta has a very big office in Miami, and I'm told they have a very nice shiny new vault, and I really want to go see it.
Yeah,
I'm not sure I'm going to be able to now that I'm on the outside.
Well, I interviewed Raphael Bostic last year, and he's mentioning the new vault in Miami. So,
but he's retiring too. So,
yeah. Okay. Well, we'll have to make a special trip down there, all three of us, and we'll take a tour of the new vault. But
it's right by the airport.
A lot of that cash, I'm assuming, is exported to Latin America.
Yeah.
Okay. And I made a Substack note. I think I shared this with you earlier, but it was fascinating to me to see that the Atlanta Fed was maybe there's one other, but definitely the Atlanta Fed was one of the few regional banks that did not experience operating losses during these past few years because had a robust currency franchise.
So, and I think I might have mentioned this to you at the time, and I actually asked Raphael about it because he was chilling out right outside my office one day, because my office at the Fed was one floor down from the cafeteria.
Yeah.
So sometimes people would hang out there. And there's some accounting rule that determines what banknotes are allocated to what reserve bank, but I don't know what it is.
Okay.
And since it was sort of sheer idle curiosity, I didn't feel like pestering my friends in accounting to ask them. And I couldn't find it by looking it up in the accounting manual. Because I don't know. I am sure there is a calculation, and I don't know what it is.
Yeah. Well, I also think part of the equation to this, though, in terms of the operating loss, is how they also distribute the SOMA portfolio. Like the New York Fed buys all of these securities, and that's generated the losses because they bought long-term bonds with 1% interest earning, and then the reserves are paying 4 or 5%. And whoever's holding, whatever regional bank is holding those bad boys, are taking a big hit. So how they allocate that also, I think, plays a role. But the Atlanta Fed is unique. It has this robust currency franchise. It's exporting abroad.
So the thing is that I'm not actually sure how much they're exporting. I know they have a big operation, but I think a lot of it is coming back in.
Okay, so net may be pretty small.
But to be honest, I haven't. I mean, I used to have access to that data set, but I haven't looked at it lately. The rule is that the reserve banks will provide cash on demand, but you got to come and pick it up. Right? So they always want to come to the closest office.
Okay.
And ideally to the office from which they could put the money on. The couriers prefer a nonstop flight.
Oh, so it could be going to other places in the U.S., not just Latin America, because it's near the Miami airport?
I mean, if it's going somewhere in the U.S., it's probably going to be somewhere around Miami.
Okay.
But yeah, definitely if it's going abroad, if it's a destination where there's a nonstop flight from Miami and not from New York, they're going to want to send it. They're going to want to pick up the cash in Miami. Okay.
All right. Well, let's move back to your work on tick data and safe assets, because this was a fascinating interest of mine for a while, at least before 2020. Like, is there a safe asset shortage? And you had a paper, Elusive Safety, the New Geography, Capital Flows and Risks. And maybe let's begin with, like, what was the point of the paper? Give us the executive summary.
So the idea, okay, so full disclosure, that paper never got to the state of completion that I would have liked.
Okay.
I think there was more to be done, and it's one of my regrets that I wasn't able to finish it out. But the idea was that there are tax haven countries, and that in those countries, because they're more opaque, people are likely holding riskier assets.
Oh, okay.
That's the basic idea. But yeah, I never got it to the state that I wanted to get it to.
So this is part of the global dollar system, people holding treasuries abroad. Any misconceptions about who's holding these assets abroad? Is it advanced economies or? Well,
there's what we call the custodial bias. It's not really a misconception. It's just a feature of the data, and we talk about it in a couple of my papers with Carol Berteau. We talk about it, and I have a more recent paper with Nissa Kim. that compares the tick data to the IMF's. I think it used to be called CPIS, Coordinated Portfolio Investment Survey, and now it's called PIP, Portfolio Investment Positions, PIP. So we did a comparison of those two, and they collect the data on a different basis. We have to look from the U.S. side because that's what we have the authority to do.
Yeah.
The IMF, however, collects it from the relevant countries. So, for example, for Belgium, what the IMF's data will say is, here's how many treasuries Belgian residents are holding.
Okay.
Right? And that number is typically much lower than what we see being recorded as Belgium.
Oh.
Right? So that's the custodial bias. So it's not really a misconception. It's just a feature or a shortcoming of the data. You can't always get everything in your data collection.
Yeah. Do you still think there is this demand abroad? I mean, a lot of talk that had fallen. What do you see in the data?
So a lot of times we see, and there's a small cottage industry in the office in sort of debunking various and sundry alarmist articles.
Yes, plenty of those.
That never say anything when there's a strong month for Treasury demand, and then when it blips down the tiniest little bit, that everybody's hair is on fire. So I think that one thing that's going on is that generally demand for treasuries and demand for U.S. assets is solid, but Treasury issuance has been so gigantic that the foreign share almost by definition has fallen. So the foreign quantity is still going up, but the share is going down just because the denominator is going up.
Yeah.
Right? So there's a lot of alarmist articles that use or abuse that feature of the data. Back a few years ago, in 2024, I think, we introduced a new way of reporting transactions that's much more accurate. But before that, a lot of times the tick transactions data would give kind of strange numbers, and people would seize upon these numbers. And one thing that Carol Berteau and I did was that we actually issued a monthly data dump of estimated transactions that we thought were more accurate, and that in fact were used by the BEA and by the financial account release. But people would still use the sort of raw transactions data even after we explained that they were misleading.
So this adjusted tick data, where do we find that? Is that on a Fed website or is that on their Treasury tick website?
So up until 2 years ago, the Fed website had an update. So Carol's and my paper was there, and every month there was an update.
Okay.
And what we decided was that basically we would give this new data collection system 2 years, and that if we were kind of okay with how it was performing, then we would kill off the estimated because there's no reason. And so we did that. We put that paper out late last year, I think. So we don't do the estimates anymore. I mean, you can still I think in that paper that sort of said we're not doing this anymore, we said, okay, but here's the last hurrah. Here's the last data set. This is it. Now just use what's on the Treasury website. Look, compare them. It's doing a good job and it's direct measurements and you should use them.
Okay.
So now it's on the Treasury's website, and I think, and we put an allusion to this in our note. They will soon have the tick data in FRED, which will make it even more user friendly.
Nice.
So I don't think it's happened yet, but I think it's
coming.
We're right there.
One of the great public goods the Federal Reserve System has provided to at least some people like me and you who use it in this country. So we've been talking about dollars and currency and tick data, safe assets. And this all kind of centers around this theme of a global dollar system or dollar dominance. And one of the, I think, important developments recently that could affect this, and I think maybe strengthen it even, is the emergence of dollar-based stablecoins. Not just the emergence, but then the law, the Genius Act, which makes it official. And I know rules are still being written about it as we record. A lot of questions. In fact, we found out today on March 4th that Kraken Financial is getting access to a Fed Master account, these limited Fed Master accounts, the skinny Fed Master accounts, as Governor Waller likes to call them, which is pretty surprising because I thought these were still being reviewed and processed. But Kraken,
So did I.
But Kraken, of course, applied first in late in October 2020, so it's been a long time. So maybe this is like a test run. We'll put it out in the wild and see what happens with this, which may be a good way to kind of work out some of the kinks. But nonetheless, to me, it's the writing's on the wall, so to speak, in terms of dollar-based stablecoins are here with us. Yes, there's concerns. Yes, there's also opportunity. And I guess my big push here, what I want to ask you about is, do you see it affecting dollar dominance? And maybe you can define what you think dollar dominance is and then what role stablecoins might play in it.
I mean, one thing that is surprising to me is the extent to which dollar-denominated stablecoins so completely dominate the market. I mean, it's like 90%, 95%, 99%. It's incredibly high. And I don't understand why that would necessarily be the case, but here we are. So, I mean, anytime there's a dollar-denominated asset that's being popularized, it's going to, I would say, increase the standing of the dollar, right? But I don't see why it necessarily has to be that way going forward.
So, an alternative.
So,
stablecoin.
Why don't we have euro stablecoins? I don't understand. Right? But the market has not supported euro stablecoins. So,
and the biggest dollar-based stablecoin is outside the U.S. Tether, which outside of the regulatory fence of Genius.
Tether made a point the day the Genius Act passed. They made a point of having a press release saying that they were planning to have some or all of their operation come into compliance with U.S. regulations. I haven't seen any news since then.
Yeah.
That could mean they're working on it and they don't want to say anything until they're all done, or they could just have been saying things. I don't know.
That's so interesting. Well,
But yeah, they were right there the day it passed.
Yeah. I think it's interesting and I dare say useful to have this experiment. Now, some might be worried about financial stability, but right now it's 300 billion plus in stable coins. I mean, Bitcoin is in the trillions. So this is in some sense small potatoes. It's an important experiment of sorts. And having Tether outside the U.S., and we know that some of their assets are riskier than like what Circle has. Mm-hmm. And let's just see what happens if we look at this crypto winter we've been in since October of 2025 when crypto took a hit. Dollar-based stablecoins have plateaued around 300 billion. And if you dive deeper into the data, you see Circle's one of the big ones actually went down. Tether actually went up.
Oh.
And Rashad Ahmad did this paper. He's a former podcast guest where he highlighted the reason Circle went down is because a lot of their activity is tied to crypto. A lot of the stablecoin usage is tied to crypto. So Bitcoin and Ethereum, they all go down. Circle goes down. But Tether went up, and Tether seems to be more used, in developing economies.
Yes.
So maybe, and I don't know, I'm speculating here, and all the people out there may hate what I'm going to say, but maybe Tether's serving more as a true substitute for like physical dollars out there.
So Tether seems to be, and stablecoins in general seem to be, a way to execute payments across borders. So, people working as translators for somebody in another country, they get paid in stablecoins, or the stablecoins of the vehicle. So they do seem to be sort of like cash, but, more mobile.
Do you see them displacing physical cash more than bank deposits? Or completely new demand created beyond the existing, stock of dollars out there?
I think it's really hard to say.
Okay.
I think I think the use case in a sort of advanced economy with many existing payment options is quite limited.
Yes.
But the use case in other countries, I think, probably just demands on the circumstances of that particular country.
Mm-hmm. And that's where you would expect to see more growth, more usage.
Yeah. And, for any kind of payment that's not person to person, right?
Yeah.
Or that's not in person, you could imagine that it would be more convenient to use a stablecoin.
Yeah. Well, it'll be interesting to see how this all unfolds and how future Fed economists who try to fill your big shoes that you've left them at the Fed, how they handle and think about this issue. But with that, our time is up. Our guest today has been Ruth Judson. Ruth, thank you so much for coming on the program and sharing your insights with us.
You're welcome. Thank you for having me.